After a tremendous run, both gold and silver are now getting pounded. Not that this is a surprise. In fact, I told you just 6 days ago that this was the most likely short run path. But now that it's here, we have to ask the question, what's driving the sell-off? And more importantly, does this change anything about the long-run trajectory of either of the precious metals? Now, silver was the easiest one to identify because it was quite obviously undergoing an epic supply squeeze. And we know how supply squeezes end every single time. In fact, here's what I told you last Thursday. Now, all that said, there are reasons to be very cautious on buying both gold and silver, at least in the short run. To start with, Indian buying is very seasonal. In fact, this burst of demand from the subcontinent not coincidentally coincides with India's festive season. You take away some of that seasonal demand, maybe all that seasonal demand, and the supply squeeze starts to normalize, and then we know what happens after then. Supply squeezes always follow the same pattern. The price goes parabolic, and then it crashes. We've seen it a couple of times in copper, including just a couple months ago. And if the inevitable short-run reversal in silver does get to be bad enough, it does start to crash like copper did, there is the very real chance, paradoxically, it spills over into gold. So where gold is yanking silver up to this demand squeeze, silver turning around and falling hard might actually dent demand for gold, at least again in the short run, especially since gold's rally is itself getting to be a little bit much on its own terms. So silver is set up for a supply squeeze correction, and one is also due for bullion. Now, as it has turned out, Thursday was the absolute top in silver, spiking above $54 an ounce. Though, that was a complete accident. It was just coincidence. It's impossible to predict tops or bottoms in any market, even where they're behaving in obvious patterns. But what about silver beyond the supply squeeze, and what about gold? Well, that's what we're going to go over here, some of the latest developments in the fundamental realm, especially in bond markets and from central banks, including a couple of things you probably weren't expecting. So as of this afternoon, silver was down another 50-some cents an ounce to 48.16. It had been up at $54 last week, as I just said, but it got pummeled by more than 7% yesterday alone. And that followed a 4% drop on Friday. So altogether down a little over 11%. So painful, but there's almost certainly more downside yet to go. First of all, the factors that I mentioned in last week's video are exactly what are driving silver into the supply reversal. The festive season in India has wrapped up, and suddenly demand slowed way down from one of the world's biggest pockets of silver fandom. Plus, with leasing rates having soared to at least 30% and some reports of a lot more during the epic run-up, it had begun to dislodge silver supplies. That's just how markets work. When prices and profits get to be high enough because something is in short supply, the market will either find more supply somewhere or some alternative to the commodity. And in the case of silver, there isn't really an alternative that isn't gold, so supply started to flood into London and India. We heard the stories of silver dealers who had access to spare metal booking cargo space on airplanes, expensive cargo space on airplanes to ship bars and whatnot. That was a clue that the deep storage inventories were indeed being disgorged, and they were going to help correct the imbalance. So now that we're here on what looks to be the other side of the supply squeeze, the question we have to ask is how much downside is there for silver? And we can find some answers in a comparable, that's copper. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video, and now let's get back to it. Now, Dr. Copper is a somewhat close relative to silver, and it has experienced 3 supply squeezes over the past year and a half or so, and each one performed in basically the same manner, in fact, eerily similar, repeating it as if they're following a template. The first one began in late February 2024, which was related to some, almost panic buying in China on hopes that the previous year's stimulus might actually stimulate for once. There's been an almost constant state of stimulus that doesn't stimulate in China and elsewhere for that matter, but that doesn't stop the markets from getting unhinged in these short-run periods. And a lot of it, though, it has to do with that increase in demand against relatively inelastic supply, deeper supply problems. So copper went from $3.86 per pound at the CME to $5.11 about 3 months later in early 2024, a nice 33% pickup. But over the next almost 2.5 months, it got all the way back to $3.93 again, giving back almost all of the gains in the short run. Now, the next supply squeeze started in December of 2024 on the threats or even just fears of tariffs being applied to various forms of copper. Again, supplies being very inelastic, that panicked demand sent the price up from around $4 per pound to $5.20, which was another 30% rise, all before the deflationary liquidations forced copper back down to $4.11 all over again, which was very near where it had started. Now, that wasn't necessarily a true supply squeeze unwind, since the downside was first triggered and then pressured by forced selling, the deflationary conditions in late March and early April. Yet it still definitively counts, since something like that would have happened anyway, even if it would have taken a little bit longer than just the 2 weeks of that reversal. And then the latest of the copper supply squeezes came just on the other side of April. So after the price rebounded initially over the next couple of weeks from the liquidation lows, the metal suddenly surged once again for the same exact reasons. Lack of supply and lack of elasticity, in this case due to the commodity being shipped into the U.S. ahead of any potential tariffs that were massively disrupting supply chains and inventories. So the price soared from $4.55 in early May to a record $5.80 by late July. That was good for another 27% increase. But once the U.S. government announced that it wasn't going to apply universal copper tariffs, the metal absolutely crashed, epic crash, back down to $4.39 all over again in just 6 days. So notice a couple of common traits in each one of those supply squeezes. First, the squeeze reversal always happens much faster than the way up. And second, they either completely round trip the squeeze or they very nearly do. And finally, what's more important beyond October 2025 for silver, overall copper's price has been moving higher because the fundamentals, in this case entirely on the supply side, remain firmly in place. So these squeezes created more volatility in copper around the rising trend driven by fundamentals. And there might be a lesson there as we go through the downside of the silver supply squeeze. Now, gold doesn't have the same supply issues as silver. However, as we discussed in detail last week, the price action for bullion had gotten quite ahead of itself as well. While it was priced for fundamental reasons, meaning financial conditions and perceptions, you could argue that in the short run, buyers had overpriced them to a significant extent. And I hate the term overbought, but gold and silver might be the closest to living up to the word's most basic meaning. Bullion reached 43.26, a then record high last Thursday after the news from Zions and Western Alliance. It sold off on Friday but rebounded on Monday to reach a new all-time high at 43.56 before the heavy selling yesterday and then more earlier today. And as of last check, gold is down to 40.44, which is a hefty 7% drop just in the past 2 sessions. Now, I don't anticipate nearly as much downside here like there is for silver, but we should expect more selling, a true short-run correction. But that's really all it is, a correction, because the fundamentals haven't changed. If anything, those fundamentals, the real fundamentals, not what you hear across the media and social media, the real fundamentals are being even more confirmed as we go along. As I keep saying, they get more, not less certain. And in this case, the more certainty goes in the direction of gold outside of the short-run volatility, whether or not how much of it is being driven by the silver supply squeeze on the downside or the correction in gold. It's the fundamentals that ultimately win out. Precious metals are a safe haven store of value, which means long-run demand for them goes up whenever it looks bad and really deflationary in the real economy and especially the monetary system. Well, we've got those concerns and then some, as we've been talking about more recently. The word I mentioned yesterday was escalation. And some of this goes way beyond strictly future worries. It's happening right now. I told you on Monday about the situation in China, the really eye-opening situation in China, which has definitely taken a turn. The Chinese economy's case is one that is heading right toward its own flat beverage. Then there's the credit market crack that's appearing from especially the shadows of shadow banking, which, by the way, is a term that has suddenly disappeared from the mainstream. Now they're all using non-depository financial institutions to make it all sound better because they realize it's starting to sound exactly the way you think it does. But that crack in the credit market is tied directly to potential job losses in the U.S. labor market, the U.S. labor market's own journey into the flat beverage territory. And on top of those, we've got monetary conditions that I've been pointing out to you leaning more decisively in the deflationary direction, which, contrary to popular perception, very big positive to gold and therefore eventually silver once silver expunges its supply squeeze remnants. And an important development in that crack in the private credit, not just in the U.S. or U.S. dollar, but this is a global system. We've seen central bankers now react to it. Not that central bankers are going to do anything, but the fact is, and I keep telling you this, the more central bankers pretend that they have to do, including investigate what's going on in private credit, the more you know there's something there. We keep seeing smoke from all over the place, and this is an example of where there might actually be some fire. We've got the recent developments from Tricolor, First Brands, and last week Zions and Western Alliance. And by themselves, if I keep telling you, they don't mean all that much, but it's the common thread in each of them. A couple of common threads. One, they continue to feel pressure to do stupid things. And number two, we keep seeing those stupid things come out in collateral. And the more the system doubts collateral, especially during periods when conditions are, let's say, less than benign, the worse that ends up being, especially when we have very little information, which is why nobody wants to use the term shadow any longer. So that has finally caught the attention of certain central bankers. No, not those at the Fed, at least not publicly. And I really doubt that we'll hear much from Powell on the matter. He'd much prefer it all just blows over so no one at the FOMC ever has to even address it. Instead, this is coming from the Bank of England. It started out with a Bloomberg report, and then it was confirmed by Bank of England officials themselves, who announced in front of Parliament that they are launching an investigation into the exposure of banks there anyway, to private credit. Governor Andrew Bailey even told stunned parliamentarians in the House of Lords he was already getting the runaround from private credit shadow bank leaders. Same as we saw here last week after JP Morgan's Jamie Dimon called out private credit cockroaches, which elicited the vehement denials that there couldn't possibly be anything buggy about shadow credit portfolios. But according to Bloomberg, Bank of England Governor Andrew Bailey told a Parliament committee on Tuesday that, quote, alarm bells were ringing in the sector. He cited conversations with industry figures who assured him that everything was fine in their world, apart from the role of rating agencies, in an echo of the confusion over the quality of debt and subprime debt securitizations almost 2 decades ago. Bailey said, well, we're not playing that movie again, are we? If you were involved before the financial crisis and during it, alarm bells started going off at that point. And so give Bailey some credit for not just accepting the smoke that's clearly being blown up his arse. What this means is that even central bankers, who up to now have been largely silent, apart from issuing reports here or there with some carefully worded cautions, that they're now taking it seriously and even to the point of taking action, or planning to take action, or announcing that they plan to take action. Going back to Bloomberg here, Bailey and his deputy, Sarah Breeden, confirmed a Bloomberg News report earlier last Friday that the central bank was speaking with firms about conducting a system-wide exploratory scenario to find vulnerabilities in the private credit market. This so-called stress test would use a similar model to last year's review of risks to core UK financial markets. We can see parallels with the GFC, said Breeden. What we don't know is how macro significant those issues are. And so much for the stress test last year, because obviously they didn't take account into private, really shadow credit markets and shadow credit players and all the exposures that we now see more clearly that all the regulated banks have and what that potentially means. Again, April was huge in that respect, because April, the deflationary outbreak, had a lot to do with what was going on in the shadows, especially offshore the U.S., which offshore tends to run into England and London as well. So the fact that the Bank of England is saying we see too many parallels, we see way too little information, we're getting the runaround from all of these private credit sources, there is a lot of smoke here, which again is going to be precious metal positive. I mean, the very fact a major central bank is on the record publicly stating it's worried about shadow bank risks and comparing it to 2008, which I think is a little bit overdone, but either way, it further corroborates the reason why gold was soaring in the first place. The most recent rise times to the closer confirmation of the U.S. labor market trouble that's going to mean a lot of trouble, some degree of it anyway, in those shadows. Now, we shouldn't expect a whole lot from the Bank of England as far as filling us in on what they find. In fact, as I wrote in our deep dive analysis just yesterday, what Bailey is really doing is talking to the public, saying we as central bankers are taking this private credit stuff very seriously. We're going to look into it, and you should all just trust us to take care of whatever it is that we end up finding. They're never going to disclose any real negatives. Either they'll publish some very watered down version of what they find, or officials will just tell everyone they found some stuff and already took corrective action. And that too, by the way, is gold positive because we all know what that means. And it does not mean the matter is in good hands. Only that it has gotten far enough, even central bankers and regulators are taking it seriously. And then there's the bond market. The bond market is pricing exactly these same scenarios, which corroborates the fundamentals that go into gold. We see bond market after bond market that is either going into the next stage of bull steepening or just continuing on the bull steepening process, including U.S. Treasuries. So we've got the 10-year U.S. Treasury rate that's under 4% and hitting a more than year low. The 2 years moving back toward its multi-year low that it set just last week. And more to the point, just look at the trends for both sides of the curve. Total and obvious bull steepening for the past several months as more and more confirmation rolls in from all of these various and related angles. The bull steepening has been so obvious, only the sell American inflationist central bankers could possibly miss this signal. And the same pattern is playing out in Germany, where the 10-year over there just hit a multi-month low of its own. And the 2-year Germany, as I mentioned in a previous video not long ago, more and more appears to be rolling over after its weird 5-month pause. And it really is weird how it's been 5 months in each interval in the bull steepening process in Germany. Either way, German rates are going lower, even though the ECB says it thinks it's done with rate cuts. No, it's not done. I mean, Italian long-term rates just fell to the lowest level since last year. Canadians, I mentioned Chinese the other day, same story there. The entire global bond market is bull steepening. And again, that's long-run precious metal positive. But it's also backed up in the front end of the curve, the short end in short-term rates, treasury bills and whatnot there. We've seen a move in treasury bills after the bills took their usual seasonal October hiatus, now joining what we see in term SOFR rates. But either way, the market is saying the Fed is not going to get in the way. They're going to talk about inflation, as we'll see in just a second, but they're not going to actually act on it. The interest rate market is moving. There's momentum is all in favor of lower rates, both at the front end, in the middle part of the curve, and out to the long end. So basically, the short end stuff sees zero interference from Powell and his fellow wafflers. And one reason why is even the inflationists at the Fed have come out in favor of not just the September rate cut, but more rate cuts up ahead. The biggest waffle in the bunch has been St. Louis Fed's president, Alberto Musalem. And he said, I could support a path with additional reduction in the policy rate if there are further risks to the labor market that emerge. I don't think we need to be on a preset course, which means he's leaning in the dovish direction too. Over in Philadelphia, Anna Paulson, she signaled she favors 2 more quarter-point interest rate cuts this year as monetary policy, it's really interest rate policy, not monetary policy, should look through the impact of tariffs and consumer price increases because there's no evidence there is tariff inflation. Speaking of Paulson, she said, for me, the bottom line is that I simply don't see the type of conditions, especially in the labor market, which seem likely to turn tariff-induced price increases into sustained inflation. Another one, the New York Fed President John Williams, he backed additional interest rate cuts this year and said he is paying close attention to U.S. employment, which has shown recent signs of weakness. The risks of a further slowdown in the labor market is something I'm very focused on, Williams said in an interview with the New York Times. Obviously, Christopher Waller's on board. He's been on board for months now. And newest Fed Governor Stephen Murrin, he keeps arguing for 50 basis point rate cuts. The point is, flat beverage is winning the argument even at the inflation-soaked FOMC. And Chair Powell himself directly referenced the beverage curve in his most recent comments. Rates at the front end are going down, confident they're not going to get the same interference from officials. Yields at the long end are going down with less policy uncertainty, but also now that, as I've been telling you since April, the economy and also the monetary system are becoming more, not less certain. So for various reasons, gold and silver simply got way ahead of themselves. Gold pricing the fundamentals, but really gaining way too much momentum in the short run. Silver, a very clear supply squeeze that was begun and triggered by its relationship, its precious metal relationship to gold. And once that happened, it created this massive supply imbalance, which caused silver's prices to absolutely explode. And we've seen some other commodities, especially copper, how that works out, particularly in the short run. So expect more pain in silver, and that should keep pressure on gold too. Lower silver prices will sow doubt in precious metals overall, plus it destroys the momentum angle. Right now, silver buyers, they're going to sit on the sidelines waiting for the price to plunge and really plunge before they even think about getting back in and buying some more. But they're going to buy more because the fundamentals, the real fundamentals, not inflation, not dollar debasement, none of those things are happening. The real fundamentals argue for greater long-run appeal, for precious metals as safe haven alternative stores of value to risky credit and even stocks, knowing that those assets do not perform well in a further deflationary environment that we keep getting more confirmation for. That's where all the signs keep pointing, whether it's the escalating situation in the private credit markets to the Bank of England outright reacting, publicly reacting to the same thing. As I keep saying to you, the situation gets more, not less certain, and that situation is becoming more certain is very intermediate and long run gold and silver positive. So there's going to be pain in the short run. We knew that was going to come, but the fundamentals are still there, and that is the problem. We did cover a lot of ground on last Thursday's video where we went over the mechanics of the silver supply squeeze and more on the fundamentals and the relationship between gold and silver. That's the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.